This is Super Investors and the Art of Worldly Wisdom. I'm Jesse Felder.
Object to the test!
Sound on it for the 142!
Warren Buffett.
Carl Icahn.
John Templeton.
Buy low, sell high. Fear, that's the other guy's problem.
Dan Druckenmiller.
George Soros.
Paul T. Jones.
Peter Lynch. I wonder why fund managers can't beat the S&P 500? Because they're sheep. And sheep get slaughtered.
Well, the podcast is back after a brief hiatus. Thank you for your patience. My guest for this episode is Dale Wettlaufer. Dale and I started in this industry around the same time, and we've taken totally different paths to get where we are today. So it's pretty interesting for me to talk to Dale about his experiences and how they formed him into the value investor he is today. One of those experiences in particular that we spend a good deal of time on is the time that he spent working with Bill Miller, a legitimate mutual fund rock star. Dale shares some of the lessons he learned over that time, and just almost 2 years ago, Dale started his own investment management firm, Charlotte Lane Capital, which is a long-short strategy that he manages today, and we also dig into how he goes about finding long ideas, short ideas, position sizing, and much, much more. So I really hope you enjoy my conversation with Dale Wettlaufer. Hey, Dale, welcome to the show. It's really fun for me to have you here. You are one of a dying breed like me, value guys who are active in the markets, and it's there are not too many of us around these days anymore, seems like. So, yeah, welcome to the show.
Appreciate the invitation. It's good to talk with you. I think we're pretty much the same age, and I think we have a lot of shared experiences. And I really have a soft spot in my heart for Bear Stearns, both the people and the institution. And Ace Greenberg was always very generous with his time.
Yeah, you know, I didn't spend a whole lot of time at Bear. I started there, but yeah, Ace was, definitely ran through the culture of the organization, and it's a shame how it all ended up, but it just goes to show that it doesn't matter who you are, you get a little too overconfident in the markets, and it can come back to bite you. I want to dive. You were kind of been around the business world for a long time. Was it your mom and dad both kind of had their hands in running different businesses, or?
They did. My dad was in the graphic arts distribution business from the day he got out of college in 1959. And in the early 1980s, he and my mom came up with a product idea, and my mom's company manufactured that, and my dad's company distributed that. And as a means of tax planning, they gave each of the kids shares in the company. And my siblings weren't too interested in board meetings and whatnot, but I thought it was the most interesting thing in the world. So that's where I learned about corporate governance and what entrepreneurship is all about, and capital allocation. And my mom really was a fantastic process manager in manufacturing, and that's sort of where I learned how management of tangible processes works.
Interesting. Well, I just asked because I follow you on Twitter, and you tweet about your dad, here and there. And so I assume he must have been a big influence on the way you look at business and that sort of stuff. So,
well, definitely. My dad was very much a great salesperson, and my mom was more the hard-nosed realist. And so I got it from a couple different sides on how to think about business and how to pursue success in business. So I learned a lot from both of them.
And then, so, obviously, they weren't directly involved in, the financial markets. How did you transition? What got you first interested in investing in finance?
So I grew up thinking that I would be involved in the family business. And in my early 20s, I figured out that the intellectual property edge from the manufactured product was going away as the knowledge of the process diffused through the industry. The distribution side was getting really squeezed to some of the big players, and my dad's business wasn't that, and so I had to make the decision that, maybe I should do something else. And at the time, I was getting interested in the stock market, and I was sitting in a broker's office here in Buffalo doing my Series 7, and I was posting on the Motley Fool. And at that time, my my first stock recommendation was AOL, and it was under 1 million subs at the time. And this was, I think, 1993 into 1994.
Yeah,
and I
wow.
remember in 1995, the day Netscape came out was the day Jerry Garcia died. I think it was August 1994 or 5. So, it's hard to believe that's 22 years ago now.
Yeah. And so is that what you were doing Series 7 and then writing on the Motley Fool? You ended up becoming an analyst for the Motley Fool. Was that shortly after that time, or?
It was. I was posting on the boards as a means of really, teaching myself and talking through things. And they liked what I had to say. And they invited me to come down there and do that full time. And so basically, I took the opportunity to learn the orthodoxy of value investing. And in the mid-late 90s, that was, not the most exciting thing around. And so, I'm a little bit of a curmudgeon, always been, even, at the age of 25. And so, a lot of people would say, geez, you're out of step. Why are you, paying attention to Warren Buffett? And I just, that was the first, after making the typical, rookie mistakes of, I'm going to buy a junior gold miner and a oil company in Sudan, and, those things blew up. I went to, okay, well, who's the most successful operator out there? And that's Warren Buffett. And so that's what led me to studying, that as the bedrock of my education in investing.
That's funny. I mean, you mentioned we're about the same age. I think I was reading the Buffett letters in the late 90s myself, and I discovered the Motley Fool shortly after that. And, that must have been late 90s, early 2000s. And really, it's a wonderful educational resource for, learning to analyze financial statements and, different value investing methodologies. And I just found that it was extremely valuable. There's so much information and there on that site provided by just a number of people. One actually reminds me, one of the people who tweeted in a question for you is there anybody from your Motley Fool days that you especially appreciate or respect, what they're doing these days?
Sure. Well, my friend Yishin Chang, who is essentially an executive in the financial services industry, I hired two people, Yishin Chang, who is very successful in financial services, and a fellow named Brian Graney, who is now a partner at Brown Advisory. So my track record on hiring is pretty good. And, Brian's a great friend. I've known him now for, 20 plus years. And Bill Mann is a terrific investor, and he was the CIO of Motley Fool Asset Management, and just a terrific all-around investor. And I think he's doing a lot of radio and other things at the Motley Fool. So I would recommend people, tune into him as often as possible. And the Gardner brothers, they're very, very smart. David Gardner's an incredible growth investor. I mean, he's got it right, I think.
Yeah, I think I bought a couple of their books back in the late 90s too, when those first came out. Like I said, wonderful wealth of information there. And you met all these guys through your time at Motley Fool?
Yeah, I joined in, I think it was 1996, and I was there for 3.5 years. The dot-com era was getting a little bubbly when we were adding a third or fourth floor onto the building and, planning a restaurant when it wasn't a restaurant, but that's kind of what I was thinking. It was a little too much on the back end. And there's a famous moment where in a big company meeting, I proclaimed loudly that we were becoming like IBM and we needed more frontline personnel. Yeah. So I started to look around, and I wanted to jump into asset management, and it turned out that I ended up 60 miles north at Legg Mason Capital Management, working under Bill Miller and Lisa Rapuano.
Yeah, I want to get to that, but before I do, it seemed like the Motley Fool was a unique community back in the day. I haven't visited it recently, maybe it still is, but is there anything like that today that you find where there's kind of a valuable meeting of the minds and sharing of information going on?
I think Twitter. I mean, I call FinTwit the most functional firm I've ever worked at. There's just so many different great points of view, and you have lots of side conversations, in the background on DM, and you meet people in real life, and it's a value add community where if you contribute something to somebody's thinking, they'll contribute something to yours. It's pretty spectacular how many people, especially on the buy side, are on Twitter.
It is, and I mean that's really why this conversation is happening. That's where I found you, is on Twitter. Right. So, yeah. So then you moved to Legg Mason, and how did you get the gig with Bill Miller?
Well, it could have been straight up nepotism. The fellow that hired me at the Motley Fool had joined Bill's outfit, I guess, a year, 16 months before that. And I was very lucky to get there when I did in 1999. There were maybe four or five portfolio managers with, at the time, $25 billion under management. And I think I was analyst number 3 at the time. So the assets to personnel, was, really high. And so that allowed me to take on a lot of responsibilities in a different, in many ways, very quickly, which was a great education. And, my feet were in, to the fire very quickly. There was a pretty bad credit crunch post.com. 9/11 was happening. Capital markets really tightened up, and that was the first firing line for me, and it worked out well. But I kind of figured out a few years later, maybe it wasn't my brilliance that got me to hold things down to 10% of book and 1 times forward earnings. We kind of got bailed out by the Fed. So, not to take anything away from Bill's style or the style that I was cultivating at the time, but it certainly helps to have an accommodative Fed when you're, all about averaging down.
Okay, so you joined in, 2000 then, or?
Late 99.
Late 99. Okay, so you, through the March 2000 peak, and then, most of the market held up through late 2000 and then started to roll over harder after that. So you basically started there right at the tail end of that blow off in the NASDAQ. And so, yeah, that would have been just a fascinating time. How was the fund handling things through that period?
Well, it's really interesting. I think Bill, over probably 6 years, seven years, realized 50 baggers and approximately on Dell and AOL. And, he figured out both of those really early. And, a lot of value investors, certainly on Dell, figured it out at 10 times earnings, but they let it go at 18 times earnings. And, Bill figured out the competitive position. Bill and Lisa figured out the competitive position and the growth, and the returns on incremental capital were such that you could hold this thing for a long time. And so, tactically, Bill made the right call in getting off of those as late 99 into 2000. So his streak of beating the S&P 500 was unbroken from, I think it was 1991 through 2006. So he just sailed right through that period.
Yeah, well, this brings up a couple of great points about him specifically. He's received a lot of criticism from, traditional value investors that, hey, how can you call yourself a value guy when you buy things like AOL and, or things, that have no earnings and, super fast growth. And AOL was probably one of the few profitable companies back then. But, and by the same token, value guys consistently, try and buy something undervalued, it gets fully valued, and it's time to sell it. That's the Seth Klarman, kind of gospel. How does he, justify, or how is his process? What is it that, I guess he saw the fact that this thing's going to keep growing and the intrinsic value is going to grow along with it. What is it about that and that process that separates him from other value investors?
Well, I've long said that Bill's actually a better growth investor than a value investor. And that's bringing up the distinction without a difference. As Bill has said, and as you'll read, John Burr Williams' books and really all of the investors that I appreciate, value is the NPV of all of the cash an investor can take out of a corporation over its life. Value is not low PE. It's not low price to book. It's not a widespread. Those are coincident with value oftentimes, but those are really heuristics. Lots of times a company at 10 times earnings is a complete value trap, which is where I get my name on Twitter. And, lots of times a company trading at 50 times earnings can be a value. So that's how we approached it in our eclectic way. I'm putting together a portmanteau there of eclectic and electric, if I may be so bold. That's Bill was unafraid of approaching things like that. And, when I look at my portfolio, I've got pretty nasty growth, pretty nasty value next to growth in the portfolio. And on the short side, I have the same thing because we looked at value differently than the style box definition of value would have it.
Yeah. Well, I absolutely agree. There really shouldn't be a distinction between growth and value. Growth is just one of the components in assessing the value of a business. I think most investors that consider themselves growth investors are really just momentum investors, though. But to me, that's an interesting thing to look at about investing in terms of owning things that it's a very difficult, and this is maybe why a lot of value investors go wrong is Buffett says, where's this company going to be in 10 years? And if you can't determine that, it's very difficult to assess that value. And so I think that's where a lot of guys go, okay, it's fairly valued today. I don't know where it's going to be in 10 years. I think you said something about Bill where he could see maybe a little more clarity in that 10-year picture than most guys. Is that a fair thing to say?
I was at a friend's block party on Saturday, and I was talking to an artist that lives on his block, and her name is Olga, and she's 85 and really bright and loves to talk about investing. And she was saying how disappointed she was in Whole Foods selling out to Amazon. And I said, well, Jeff Bezos, the day after that, or the day it closed, they dropped the price of a lot of products by 25%. And lo and behold, the footfall in the stores goes up something like 20% immediately. You have to think about problems in a non-linear way, and I think investing is a very creative undertaking when you're looking out 10 years, 15 years, 20 years, and I think that's where Bill, given his really wide variety of interests and agility in moving from one discipline to the other with great dexterity. He's very creative in thinking about what may happen over the next 10 years, 20 years, and what may not happen. And, that's what it's all about with certainly with long runway growth companies like an Amazon. I mean, Bill, Legg Mason was, top 3 holder behind Bezos, IPO investor in Google. Certainly AOL was a, highly differentiated call. So, it takes looking down the road 10, 15, 20 years. The other thing, though, is when you look at Amazon and you do a DCF of Amazon, and let's say your cost of capital, your WACC is 8%. That perforce means that they are reinvesting the free cash flow that you project as an investor at an 8% IRR. So you're taking it out and you're discounted at 8%. You can take an alternate line in a DCF and you can say, okay, I'm the mortal that can only see this explicit opportunity, but Jeff Bezos is certainly better than Dale Wettlaufer at finding great businesses to invest in. What if he can invest those free cash flows that I'm forecasting at an internal rate of return of 15%. So that's Bill Ackman has tried to get to this with platform value calculation. That's how I look at it. When you break the circularity of the DCF via that WAC line.
Interesting. For me, I use a very simplified, discounted cash flow model where I only forecast like 3 years worth of earnings and then a terminal valuation. And that's because I don't have that ability to kind of make those assumptions farther into the future. So is Amazon a company that you own currently, or?
Mm-hmm. Yep.
Oh, okay.
I peeled it back a little bit, too early, but it is, up in the top half of the long book.
Okay, and now this actually gets into something, that I get asked all the time, and it came in on Twitter a couple times. How do you look at position sizing for something like Amazon? And I mean,
Sure.
You don't have to go into obviously the specific details, but this is something I get asked all the time. It seems to me that, Bill and the fund was not as focused as kind of a Buffett style, but you go ahead and tell me,
Sure.
Your knowledge of that.
So there are a couple of different dimensions to sizing Amazon, and I'll go to, or any position within the portfolio. I'll go to the most general statement that, the more upside in a position, the bigger the position should be. Now, that's the Kelly criterion, where you take your confidence in the thing and your upside downside and you size appropriately. And that's been kind of the, standard answer in the industry for the last 10 years. Now, I worked with a brilliant quant at Legg Mason Capital Management, Arturo Rodriguez, who has a firm called Simplexity. And he did a modified Kelly, where he looked at 18 different GICS level 4 or GICS level 3 industry return distributions monthly over 60 years. And what he found was there are 3 basic shapes of return distributions. There's left skew, which is like banking is typical. So when a bank gets to 1.5 ROA, their returns to scale are unitary after that. So there's kind of a wall as to, you get to 200% a book and it's done. But there's a lot of failures that, things go, get diluted at 10% a book. They go bust far more often than you would like. And then you have a log normal distribution. And I would say like Brown-Forman, which makes Jack Daniel's, not bourbon, Tennessee whiskey, that has a pretty even distribution. Some of the times it's, at 14 times earnings. Some of the times it's at 25 times earnings. And these things rarely go bust. And, they rarely give you runs of 50%, compounded over 10 years. And then you've got a Pareto distribution. And that's something like let's say Intel or application software, or even something like a Tesla, where you have a large number of failures, and this happens often. And you have a smaller number of successes, but some of the successes are ridiculous, 1,000-bagger moonshots, and that makes up for the the high number of failures. And so I tried to balance the book. I don't try to make it beta neutral or distribution neutral, but I pay attention to those distributions. And so, when I look at, some of my mistakes in investing, it'd be averaging down companies with a left tail distribution. That's a good way to consume capital and ruin a track record. You have to be very careful about how you average those down. And so when you look at Paul Tudor Jones says losers average losers, and Bill Miller says lowest average cost wins. I think the truth lies in between there. I think for left tail left skew distributions and for Pareto distributions, you have to be careful about how you average those. And then finally, when I have Amazon in the long book, that gives me latitude to short things like Tesla, which I'll go ahead and say it. Those things move, together. PayPal and Amazon, which I'm long, move together with Tesla, and I also have a video distribution platform on the short side of the book, and those all move together. So, and there's a reason for that. It's not just money flow, but it's the distribution that attaches to these groups.
Okay, so you look at things like leverage and volatility in the underlying business in terms of averaging down and position sizing. That's interesting to me because I haven't heard that too much before, and that's great advice, I think, to people who are looking to understand how to size positions in their own, managing their own money. If you have a very conservative, low risk, low business risk type of investment, like you said, Brown-Forman is a great example. Whiskey maker, I've been making Jack Daniels forever, and very little underlying volatility in the business. And as long as they don't leverage the balance sheet up like incredibly way too far, probably the risk of them going out of business is very small. So you can actually position that more aggressively. Now, so do you in the long side of the portfolio? What do you have? 40, 50 names, something like that.
18 right now.
18. Okay, so it is more focused.
Mm-hmm.
It is more focused. Yeah, and so for me, I lean that way too. Simply, because Warren Buffett, wrote, why add money to your 30th, 40th favorite name when you can add more money to your first favorite name? And so that's kind of one of the ways I look at things. Is that how Miller did it too? Is it more focused approach?
Yeah, I would say the top 10 positions in the fund were always probably close to 40 to 50% of the fund. And so, you have things that get demoted through through drawdown. He wasn't really a starter position guy, but that's just kind of the way it works. So my long-short portfolios have always looked barbelled. And the first fund that I ran, we had a maximum of 16 positions. It was a sleeve of a 100 position Russell 1000 portfolio. So I had 16 maximum slots, and I would run generally 12 to 13 to 14 positions, and the top position would be anywhere from 7% to 12.5%, 13%. So, I've always felt comfortable that way. I think a lot of newer, hedge funds, separate account strategies, people are really taking it to an extreme and going down to like 6, 7 positions. And I don't think that's an institutional product. I mean, it might work, for high net worth individuals and some certainly allocators, but I don't think that's quite institutional. But I know quantitatively that the incremental benefits of diversification start to drop off after 16, 17, 20 positions.
Yeah, and so you have about the same number on the short side.
Well, the short side's a little more fractional. I've got right now 32 positions. But right now I've got an 18%, almost 20% short position in the spider.
It's a lot easier to. I think it's a lot makes a lot of sense to be more diversified on the short side for sure.
Well, I'm okay with the salience there, but I've been pretty cold for the last 18 months on the short side. And George Soros used to take capital away from portfolio managers, especially if they were getting aggressive and trying to make it back. And that's something I'm definitely not doing. But I'm just kind of taking capital away from myself in an active management approach and just giving the index a little more of the capital.
Just because, the market's gone straight up since January 2016 and taken a lot of stuff, highly leveraged companies is kind of, the stuff I would focus more on the short side, things that look like they could probably go out of business in a downturn. And those things have just rallied so hard in the last, 12 months since the election. Is that those kind of the things that you're talking about?
Yeah, I mean, the things that have really been, a bit of a problem for me are industrials. I think that people believe that a new cycle is coming and it's going to be great, but I don't see that given that we have smushed 2 cycles into the last 15 years. And normally a cycle within like earth moving equipment from peak to peak, trough to trough is in anywhere from 15 to 30 years. And so, we had a long run from essentially the late 70s, early 80s, 85 to 2001 or so, where CAT didn't do a whole heck of a lot, and nor did energy. And then, you have capital leaves the industry and you have consolidation, whatever, and you have a natural cycle, and that's the way it should look. And the cycle ended in 08, and along comes quantitative easing, which pulls forward investment demand, and you've got the Belt and Road build out and China, gunning its GDP from whatever it is, 3 trillion to now 13 trillion. We've smushed 2 cycles into a very short period of time. And I don't think, left to its druthers, the earth moving equipment industry is going to go anywhere for 15 years until the next cycle starts. So, in the short term, I'm wrong. Absolutely. But I'm fine with that. I'm very comfortable with drawdowns, especially, getting back to what I was saying about distributions. This isn't, let's say our short PayPal, and, it gets away from me and it makes the jump into hyperspace where it goes from 400 billion in payments, TPV to 4 trillion. That's the sort of thing that kills you in shorting. I'm perfectly fine with CAT, going up 50% or 30, whatever it is, 30% on me. Perfectly fine with that.
And that's because it's positioned, such that you can add to it, or actually you don't need to. When a short goes against you, kind of adding naturally to it as it goes against you.
Yeah, but, right. That's exactly. I'm naturally averaging it at a pretty slow rate, the rate at which it's going up. It's moving into the right tail of its distribution. So the ride from the right tail to the center of the distribution would be terrific. And then the ride from the right tail to the left tail of the distribution would be super fantastic. And, people say, well, you can only make 100% on a short. Well, nonsense. You can always average a short as it goes down and monetize it, over and over again.
And so for me, when I hear you saying all this, I just start thinking about, where we are in the credit cycle. Is that something that factors into your analysis you think about a lot?
Sure. I'm the sort of macro investor that looks at, or I'm the sort of investor that looks at very big macro trends. So where we are in the credit cycle, what does return on capital for the S&P 500 or sectors look like? What does the earth moving cycle look like? And, if you look at earth moving equipment sales from the 1950s through today, and you look at that versus world population or global gross economic output, you use a slow moving denominator, the cycles are really identifiable. These things are very, very extended. So, when I look at something like a PACCAR, which is a fantastic manufacturer of Class 8 trucks in the United States, you have to pay attention to the truck cycle. There's just no getting around it. One of the things that I find perplexing is, it's almost a sin within certain groups to look at macro. But when you think about an equity, a U.S. equity, the U.S. market is a derivative of the global economy. An industry is a derivative of the U.S. economy. A company is a derivative of the industry. And equity is a derivative of the entire capital structure of that firm. So you've got a quadruple levered derivative. Why wouldn't you be paying attention to everything above you in the capital stack and in the entire ecosystem? It's complex, sure. One thing I don't do is, a lot of investors who pay attention to macro think that they understand every little button and knob on the, nuclear plant power panel. I don't know how, I'm a simple guy in those terms. I pay attention to some really, really big things, and I'm interested to hear how people explain things, but I don't pretend to know how, what every little button does. I pay attention to some big, the tachometer and the speedometer, basically.
Yeah. And so those are, I know that, is it truck tonnage? Is that one of the things, the indicators that you follow closely, or?
Yeah, I remember the first time I met with Ed Wolf, who was a bear guy and went on his own. And this is maybe, I don't know, '04 or so. And I've been a lifelong generalist, and I just took the meeting because I would kind of take any meeting because I could always learn something. And he started to tell me about, car loadings and truck tonnage. And I was like, wow, man, why haven't I not been paying attention to this stuff before? Because, for material goods moving through the economy, you can't truck nursing services or, other things, service-based things or software. But, still, I think half of
the business cycle is still industrial production. And
very much,
it's the old Dow theory, right? I mean, if industrials are on fire, you should be able to see it in the transports, right?
Very, very much. And I mean, that's kind of the incremental mover, from '05 down to '08 and, from, 2010 forward. And I think, coming around the bend now, the high tonnage elements of the economy, those being auto production and home building, auto sales are like 2008, like early 2008, they were really plummeting, and they were plummeting before Hurricane Harvey hit Houston. And I think the housing market is, home building is going to be done pretty soon too. Now, it doesn't mean it's going to crash, but I think it's kind of done.
And those are two, major segments. Why is that's something I've been watching too, is that auto production, auto sales, and the figures are nasty, especially for GM and Ford. Why do you think nobody's really paying attention to this right now? Because to me, it seems like it's pretty obvious what's going on.
I don't know. Hurricane Harvey made landfall in southern Texas, I think, on the 25th of August. And I was reading something this morning that said, there's basically tying the economic weakness in August to the hurricane. Well, I don't think we've seen anything yet on that score. And, auto sales were down an annualized 600,000 in August. That more than makes, the cars lost in Harvey do not make that up. Maybe just make that up. But I think a lot of people don't have adequate insurance coverage on their homes. And I don't think necessarily people are going to run out and use their insurance checks to replace their cars. There are different modalities that are becoming available. And really, do you choose between your home and your car? I think it's pretty simple for a lot of people. It's time to get creative on how you budget.
Which is a terrible tragedy for the folks going through it. But from a big picture perspective, it seems like the attitude right now, the consensus is that the rebuilding is going to be great for the economy, without looking at the costs that have already been incurred. I guess is that the age-old economic adage about the broken window and the tailor's shop and. Right. Well, that's great for the economy because he's got to replace that window. Well, what about the lost the added expense for him this quarter? It's completely offset. So it really is whatever boon to the economy it is. It's also a bane to somebody else's business existence. So, and so what are your thoughts generally about the hurricane? Do you think it is that net economic just neutral, or do you think it's going to obviously people are using it as an excuse right now. Oh yeah, the numbers are going to be poor because of the pair of hurricanes. But what are your thoughts about it?
Well, I think it's a net negative. So first of all, it doesn't improve the wealth of the country to replace what was lost. Now, if you're getting a superior home that gives you lower total cost of ownership in the future and more hedonic pleasure, okay, fine. But, that money's got to come from somewhere. And where it's going to come from is deferred or just completely canceled consumption and other investment spending, first of all. Second of all, the insurance coverage for flooding in Houston is completely inadequate. Third, I don't think the GDP or gross output of Houston will be back to potential for many, many, many quarters. You look at the last 2 weeks, and 50, 60,000 people a week have filed initial unemployment claims in Texas. I think this is going to be a bad credit event regionally and perhaps nationally.
So do you think this could be the the catalyst for the end of this this wonderful expansion that we've seen for however many years?
Well, I wrote about as the hurricane was happening, how the 1906 earthquake and fire in San Francisco preceded by about 15 months, and I think perhaps catalyzed the Knickerbocker Bank failure in the panic of 1907 in New York. There was, still an agrarian economy, and correspondent, I forget what the word is for outlying banks across the country, and a lot of people made the point, well, we're still on the gold standard. So yeah. That's completely true. I mean, we had a inelastic money supply. I don't know, and a lot of people I think asked when you put out call for questions. Well, why has Dale been so wrong? Well, I have been wrong, full stop on that. But I'm sort of indifferent as to whether the market closes the gap between where it is now and what I see as fair value at 1,800, whether it does that in a nanosecond or 2 years or 3 years. It would be commercially convenient for me if it would do it in a nanosecond. But yeah. I think the embedded return here on the market, looking out over 5-6 years, is zero real. And the funny thing is, you often will post Hussman's analyses. I get to the exact same numbers in a completely different way, but I get to the exact same numbers. That's
what I wanted to ask is how. So, how do you come up with the fair value number that you're looking at?
I'm a DCF guy, so I do it via DCF.
Right. Yeah. Okay, so you just run a DCF, and then, but the underlying assumptions on the DCF, you have to assume the lowest growth rate, far lower than anything we've seen, historically, for earnings growth. I think. Would you make that assumption?
Well, I've looked at this before, and one of my favorite papers is titled "What Risk Premium is Normal" by Rob Arnott and Peter Bernstein. And they explain from 1871 through 1999, the real EPS growth rate of the market was 1.7%. And I chopped up that period and I updated it to 2016. Every 10, 15, and 20-year slice of the market of our economic history from 1871 forward, that 1.7% is almost like a law that was written somewhere, in nature, that's the natural rate of growth for the S&P 500 EPS. Now, if there were not bad M&A and not dilution of interests, owners' interests by management and bad boards, the potential growth rate of EPS would be something like 3% over time. But there's friction within the market from bad M&A and from stock option dilution, and then you have friction from companies that are not in the index, that are innovating, that are taking share, and the profit pool from companies that are in the index. So that 1.7% is a fantastic base rate. It's a very good starting point, and that's a huge part of my process as well, as understanding what base rates are. You can't just pick numbers out of the air because they feel good. Right. You can find base rates on things. There's so many data out there to analyze.
Yeah, and I think, is that from the Shiller data, the earnings number? Is that from the paper that you mentioned? Because I looked at the Shiller data, and people have basically select time periods that support their own thesis, right? So you select an earnings growth period. Average real growth was 3.5% or 4.5%. And that's what we should assume going forward. And I think that's we need to cut out all the earnings growth during the Great Depression because that's never going to happen again. And so,
right.
I bet when you just look at the entire data, I think it does. Yeah, it is right around 1.7 or something real.
Right.
For the Shiller data.
Yeah, I think Shiller uses the Cowles Commission data, and I know Yardeni uses it. So the great thing about Shiller is he's got that wonderful spreadsheet that is updated all the time that I use as a base for a lot of things.
Yeah, and I'll include a link to that when I put up a post for the show notes for this. I'm glad that you brought up, was it the earthquake? The history, I think. So few people have an understanding of market history, and there's so many things. Now, I believe that Mark Twain, it's not a true saying of his, but history does rhyme, even though it doesn't repeat. And there's a lot to be learned from those types of things. And so you shared that on Twitter, and I'm glad you brought that up. Do you feel like this is a similar situation to that? Then I know you said we're not on the gold standard today, but if you look at the growth in the money supply currently, we might as well be almost with what's going on.
Right. Well, I'm not a doomsayer that says this and that is going to lead to a crash, but I was listening to Hugh Hendry on the Macro Voices podcast the other day, and he closed his fund, and he was drawing an analogy between today's market and the 1960s. So posted on Twitter, I lined up, 15 different data series, and I compared the 1960s with today. So the 1960s real GDP on average was growing 4.7%. We're growing 2.2%. Real DPI was growing 4.7% again. We're growing at 1.2%. Real DPI x personal current transfer receipts, which is a very important thing to think about, because the classic C plus I plus G plus net X equals GDP calculation. I remember the first time this was mentioned to me in Econ 101, and the professor started talking about transfer payments. And I'm like, what do you mean transfer? Like, why isn't that in the government account? Well, because that goes over to consumption, and it's also counted in income. So 80 years ago, personal current transfer receipts were only 7% of disposable, in the 1960s. Personal current transfer receipts, which is Social Security, Medicare, Medicaid, essentially, was 7% of disposable personal income. It's 20% today. That's a huge, you got to look at the trends adjusting for that. So, another series is household liabilities to adjusted income, as I just explained before, DPI minus BCTR. 63% in the 1960s. It's 113% today. Federal government liabilities to household income adjusted, 55% in the 1960s, 118% today. And by the way, ultimately, it's the household sector that's responsible for this, right?
Right. And so what was it? Where did he see the parallels? Obviously, I've seen Nifty 50 parallels, with the FANG stocks and those types of things. Maybe, there's some market parallels, but you're right. The underlying economics is far different than it was back then. What were the parallels that he was trying to make? So
if you want to look at, I'm not sure entirely, but like the trailing 12-month PE on the S&P 500 is similar. The Cape 10, which is the classic Shiller Cape, is much higher. It's 28 times today versus 21 for the period of 1960s. The Cape 5 is 25 times versus 20. The S&P 500 dividend yield is 120 basis points lower. Now, real S&P 500 EPS growth is now 9% today versus 4% in the 1960s, but that's really juiced by energy coming around the bend. But inflation is lower. Real 10-year yields are lower. BAA yield is lower today. BAA spread is actually higher. You can look at the valuations and they seem somewhat similar, but guess what the 10-year forward S&P 500 real return was from on average in the 1960s? It was 0. And from 1965 forward, it was negative 2.7%. That's your 10-year real return.
Well, that period from the mid to late 60s to the 81, 82 was just, that's why it takes something like that to get the death of equities, business we cover that marks the bottom in 81 or whatever. But maybe, he was looking for, and I think I read something about this on Twitter, looking for a pickup in inflation that maybe would precipitate a 73, 74 style, bear market. Is that fair?
Maybe he was being sub rosa about it, but it didn't seem like he was drawing a bearish conclusion about it. But
interesting.
I don't know.
Okay. Well, you mentioned before we started recording that you're working on a systematic investment process. It sounds fascinating. Can you tell me what that's about?
Sure. So a mutual friend put me together with a fellow named David Van Adelsberg, who is a financial services entrepreneur, kind of a wide-ranging entrepreneur in Philadelphia, as well as with behavioral economist Dan Ariely, who I think everybody who studied behavioral finance knows. And the idea was, could we look at human behavior in the workplace and use that as a useful input into forecasting excess return, both positive and negative, from that point forward. So we've been spending the last 10 months gathering proprietary databases and putting together behavioral hypotheses that we're not just spraying the database with every known statistical technique. We're coming up with hypotheses as to, if a bunch of people say this in the workplace, does that mean the stock is a buy, or could we short it? And we've actually come up with some fantastic back tests. And we've beaten these data up as much as possible.
Yeah. So where does the data come from? What people say in the workplace? What is the source of the data?
So various proprietary human resources surveys, and we are going to be developing our own data to enrich the data set. We think we have generalized hypotheses that when we have even better data, will improve our results even more.
Geez, that to me is fascinating. It's one of the things I feel like I try to do on a week-by-week basis, but it's not necessarily what people are saying in the workplace. It's kind of what's reflected in the media. And one thing that I'm noticing now, I think a lot of people are starting to notice, but not necessarily reflected in the markets, is there's a lot of, I think the sentiment towards the FANGs, and maybe most particularly Facebook and Google, seems to be shifting towards more of a antitrust or regulatory type of environment. And I tweeted an article today from the Wall Street Journal over the weekend. It seems to me that sentiment is very, very clearly shifting towards, oh, you know what, they have all our data and we're okay with it, to maybe we're not okay with it. And I think that's a fascinating just sentiment shift that I'm witnessing. But if you're finding a way to quantify that, and that would be very interesting to see what you guys come up with. Are you guys going to be releasing some of that information? I mean, your results here?
So I know we'll be doing white papers on it, and we are very near a product. And there are a number of different products that we're thinking about rolling out in various forms. There's no reason why this couldn't extend to the credit market. If we have a way of avoiding blowups, that's what like high yield portfolios are all about. I mean, if you minimize the default rate and severity of default within a portfolio, you can, actually do well. So for instance, you said Facebook. Like, let's say you polled everyone at Facebook today and everyone said, oh, it's great. We're all so happy. Well, you know what? Guess what? The market knows that. That's no secret that things are going well there. But what if you're seeing, an interesting data signature of unhappiness emerging? That's valuable information. So, again, it all comes down to behavioral analysis and real, scientific method. And ultimately, companies are groups of people. And what we found is, I'll draw a sports analogy. So there are some hockey teams or European football teams or American football teams that it's a bunch of grinders without a whole lot of stars. Sometimes those entities will outperform other entities that, there's divisiveness and there's like one or two stars or locker room cancers. We have a way of finding the muckers and grinders that all know how to pull on the, oars, at the same time in the same direction. You can see that in how people describe themselves in their environment.
Well, I love the sports analogy. I'm a huge hockey fan, and hockey is definitely one of those sports where you have a superstar who's not a team player, and it doesn't help you very much come playoff time. But speaking of another sport, I think, are you a golfer?
Yeah, misspent youth. I'm not golfing a whole lot these days, but I was privileged to be around a lot of good golf growing up.
I'm not playing as much golf these days as I have in recent years, but I love hearing from investors and their hobbies and some of the parallels that they find or what they learn. Mark Yusko talked about, I think, fly fishing and how that's so valuable to him to just calm his mind and focus on one thing. And is there anything about golf that has helped you become a better investor?
Sure. Yeah, it's I would go around with my dad on Saturdays and Sundays, and he would discuss with me course management and when you're off, how to miss small and how to look for a bailout area. If you miss the green, you don't want to be over this green. You'd prefer to be in this bunker. If you get stuck in the high grass, go out sideways. Don't try to take a 3-iron out. Remember Jean Van de Velde in the British Open?
Yes, of course.
It's so terrible because he hits, he's 5 strokes ahead and he puts it in the heather, and then he tries to hit a 3-iron out of the heather, and he ends up in another bad situation. He could still go out sideways and get down in 3 and win by a stroke or 2. And it was just this compounding of errors. And I caddied for my dad in it was either the 1990 or 1991 Senior Open, and he missed the cut by 2 because he was an amateur golfer, lifelong amateur golfer, and he was running a business at the time. And he missed half the fairways in that tournament, which is, death in a USGA tournament.
Yeah,
he was getting up and down from everywhere, and that was his risk management strategy. Was if you're going to make a mistake, don't make it deadly, and don't compound it. Don't try to get it all back.
Yeah, no, I've played some tough courses. I think a few years ago I played Bay Hill, Arnie's course down in Florida, and the rough was growing out so deep you could lose your ball at a foot off the fairway. And whenever you did find it was just take your medicine and try and put it back in the fairway, right? Because if you try and do anything more than that, you just make it worse. But golf is a sport for me that I'm always finding parallels to investing, and it also teaches me, about myself a lot, how you handle adversity on the golf course, and those types of things can also be valuable. But anyhow, well, Dale, thank you so much for taking the time to do this. I really appreciate being able to pick your brain. It's been really enjoyable for me. Where can people who want to keep up with you and your ideas and thoughts, where can they find you?
Well, Twitter's my office, so my DMs are open, and I have a lot of conversations going throughout the day. So that's a good way to get me. And I post snippets from my letters and whatnot. So I try to keep it buttoned up on distribution list, but I'm always around, really.
And on Twitter, it's at
ValueTrap13. At ValueTrap13.
At ValueTrap13. Perfect. Okay. Yeah, thanks again for doing this. It's been really enjoyable, and hopefully we'll do it again soon.
Enjoyed it. Thank you very much, Jesse.
And that does it for another episode of Super Investors in the Art of Worldly Wisdom. Again, for notes, links, and all kinds of other stuff related to our conversation, visit thefelderreport.com/podcast. If you're really enjoying the show, do me a favor and rate it on iTunes, or just forward it, share it with somebody you think might like it. I'm truly grateful for all of your support. And until next time, buy low, sell high.
Looking good, Billy Ray!
Feeling good, Lewis!
Man looks in the abyss. There's nothing staring back at him. At that moment, man finds his character. And that is what keeps him out of the abyss.